The Goldirak's possibility in the United States is raising its head again as the Dow-Jones indices rose for the 10th day in a row. The New York stock market welcomed the performance market following the Nasdaq rally. Initially, the forecast for this year was pessimistic as the performance of major companies come out higher than that. The rise in the index is being accepted naturally. Goldirak's refers to an ideal economic situation that is neither too hot nor too cold. Goldirak's is a term used to describe an optimal economic situation in which inflation and interest rates rise slowly despite rapid and sustained growth. Recently, American online shopping companies led by Amazon are posting record-breaking sales. On the other hand, although the U.S. shows a high wage growth and strong consumption, inflation indicators such as CPI and PPI show a slower pace than expected. August 14th, 2019 local time, an unusual phenomenon occurred in the New York bonds market in which the yield on 2-year Treasury bonds rose higher than the yield on 10-year Treasury bonds. Normally, it is normal for bonds with longer maturities to have higher interest rates, reflecting future uncertainty. But the opposite is true. An inverted yield curve is considered a strong sign of a recession. In fact, there have been 5 inversions between the 2-year and 10-year Treasury yields since 1978, leading to a recession after an average of 22 months. The interest rate inversion on this day was the first in 12 years since June 2007, right before the global financial crisis. Even until early 2021, people thought a lot that the inflation era would not come again. However, globalization came to an end as global supply chains were paralyzed by the US-China trade war, the COVID-19 pandemic, and the Russia-Ukraine war. As policy and deglobalization strengthened, the trend of nationalism, protectionism dominates. These phenomena have increased inflationary pressure. The U.S. Consumer Price Index for June slowed faster than expected. The possibility of stopping interest rate hikes by the U.S. Federal Reserve is also relatively high. The consumer price index in the United States rose 3% in June compared to the same month last year. This is below the May increase, as well as the Wall Street Journal's forecast. This is the first increase in 2 years and 3 months since March 2021. In addition, the core consumer price index, excluding highly volatile food and energy prices, recorded a 4.8% increase in June compared to the same month last year. This is also below market expectations and the level of the previous month, and is the lowest increase in 1 year and 8 months since October 2021. The Fed sees core CPI as an important indicator. As indicators show that personal consumption, which supports the U.S. economy, has plummeted one after another. Analysts say that the U.S. has already entered a rolling recession, a form of economic slowdown. A rolling recession refers to a type of economic slowdown in which a slowdown that starts in one sector or a region affects other sectors like a domino. Instead of the economy falling into a recession all at once. While a recession may not be officially declared, the perceived deterioration in the sector is palpable. This means that consumption slows faster than inflation. Inflation fell as expected, but consumption adjusted for inflation fell more than expected. This suggests that consumption in the United States may not simply be a measure of consumers reducing their spending due to rising prices. On the other hand, the recent economic downturn shows a rolling recession, in which the economy freezes in one sector but vigorously expands in other sectors. Massive layoffs occurred in the tech and real estate sectors, which were hit by interest rate hikes, but the hotel and leisure industry is an example of large-scale hiring. So, why is the U.S. economy showing a rolling recession? It may be because the economy is still not completely free from the effects of the corona pandemic. This is because the speed of recovery from the blow of the pandemic and the process of falling into a recession after that are different for each sector. Sector and the real estate sector shows the best growth during the pandemic. Sales surged as demand peaked on the back of low interest rates, increased liquidity and ample household funds. On the other hand, sectors that require face-to-face contact, such as hotel, leisure, retail, and service, suffered from a continuous labor shortage. On the other hand, the process of rolling recession is also described as a so-called hope cycle. In other words, the economy peaks in the order of housing, new orders, corporate profits, and employment, and falls into recession. Profits have now passed their peak, and employment is expected to follow sooner or later. The problem is that the hope cycle is not met with a rolling recession, and employment continues to be strong. This is why the Fed cannot easily cut interest rates.